In this video, I will review the latest earnings report from Williams Sonoma, Q4 2024. In the first part of this video, I will introduce what is Williams Sonoma, why it matters, why I think it's a great company, great management, and after this, we will look at the results, and I haven't looked at them yet, so it will be a live reaction, I guess. Just for the sake of the disclosure, I bought Williams Sonoma a few years ago. It was in 2022, around here. You had a split, so price adjusted at $60, double down at $65, $55, triple down at $55, $60, and then it shot up to the stars in 1 year, 1.5 years after 2 years of accumulation, and I sold around here. Okay, and after I sold, because God is watching me, the stock went up and it went back to the same level where I sold now because after this report. If you look at the company, Williams Sonoma is a great company. If you don't know what they sell home furniture, tables, beds, very simple business model, kind of pricey, kind of semi premium. It's not a luxury brand, but it's good products, good quality products, and they have good margins because they are in the higher end kind of luxury, but not this type of luxury category. Good operating margins, and this is a long company. What I say is an old company. So if you look at the growth rate for this company, they don't grow a lot. If you look at the revenue increased massively during COVID and now is stabilizing. If you look at the net income, you have a strong improvement during COVID and now they are struggling to stabilize. It's a furniture company, so a lot of people were stuck at home during COVID. They did again their new tables, new bedrooms, new kitchens, etc. And this is what is explaining the growth. And the company doesn't have any debt. What you see on Guru Focus are leases, which are not real debt. So if you purely look at the balance sheet, officially, they don't have any debt. You have leases, you can include them or not, I don't. So debt-free company, growing a little bit, profitable, good margins. Look at the free cash flow of the business. Here we go at the left, here in blue. Free cash flow is not growing exponentially, but it's still growing. For a retailer that is supposed to be cyclical, they are not cyclical. They are continuing to make profit, and the ROIC improve. The return on invested capital, a metric that I love, went from 15% before COVID to now 30% after COVID. And seems like you have no reversal to the mean. Seems like they are stabilizing their operations, and this is exactly their goal. And they don't, I've been following the company for some years now. The goal of Williams Sonoma is not to grow massively. They plan to be efficient, to grow margins, grow profitability, return on invested capital, and returns for shareholders. And one way of distributing capital to shareholders is through buybacks. Look at this, all these green charts, all these green bars that you see. Here in 2022, they bought back 6% of their shares. When I bought here in 2022, after this, in 2023, they bought back 8% of their shares. In 1 year, in 2024, they bought back 3%. In 2025, they already bought back 4% of their shares. So massive buyback candidate. And they have a small dividend yield of 1%. So pretty simple business model. And the reason I sold was valuation concerns. I bought when the PE ratio was quite low, and I sold when the PE ratio was quite high. But if the stock is going down again, maybe I will buy again. So let me show you the evolution of the PE ratio. It's a very simple value investment and has made me a lot of money. So pretty happy with the company and the strategy of the management management team has not changed. So let me put the price earnings ratio of Williams Sonoma. Okay, here you go. You have the evolution of the PE ratio over time. I bought here, PE ratio of 7. I bought more here, bought more here, PE ratio of 7. And then, because growth picked up again, focus on efficiency, more margins, more buybacks, for some reason the stock went up to a PE ratio of 20, roughly 20, and I sold at these levels. And now the company continued to increase, the stock price continued to increase at 24, and now back to 18. If it drops to PE ratio of 12, 13, or even below, I might buy it again. So you know the company, you know the management philosophy of being efficient, you know they have stabilized their operations, they don't focus on growing, they focus on efficiency, margins, ROIC, buybacks, and the only worry we may have at the moment is the high PE ratio. You have the story for Williams Sonoma. Great management team. Laura Albert is doing fantastic stuff. They released earnings a few days ago, March 29th, 2025, and I don't think a lot of my viewers know this company. This is why I made this short introduction. Okay, they have this investor presentation. I think what I will do is I will go through the investor presentation. It will be easier for you to understand how they think. And after this, we will take a look at the earnings report. I think that will be enough for this video. No need to go through the earnings call at least for this video. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. So, okay, you know what? Let me start. Okay. Let's see what they have to say. Let me just check something for the mic. Okay, this is a new mic. I hope it is not saturating. So I'll do my best, guys. Okay. If you look at the key metrics of this business, as I told you, they don't plan to grow massively. They plan to be efficient. One way to be efficient is to go through e-commerce instead of retail. You have less employees if you sell your tables online. They talk about their ROIC, earnings per share growth, operating margins, and return to shareholders. Exactly how I pitched the stock. I don't see revenue growth. I don't see a key customer acquisition growth. No. Just focus on efficiency ROIC, efficiency earnings per share, efficiency operating margin, and returns to shareholders. Sometimes it's that simple. Expensive market opportunity. Yeah, I mean, they are not a leader in their category. A shift to e-commerce. What is great is Williams Sonoma was the best beneficiary of the COVID era because they already had kind of a catalog and they just shifted their operations online. And if you compare this stat of having like 70% of their operations online, if you compare this percentage to other retailers, competitors, they are way ahead. And this is why they benefited so much from COVID. No, this is a competition. I like restoration hardware here, RH, led by Gary Friedman. This is great company also, a smaller company. You can check online, do some research on RH. This is a savage company, and since you are with me on this video, let me give you an additional value. I mean, you have clicked, guys, so you are with me now. Restoration. Come on. Let me put RH Guru Focus. Gary Friedman is a brutal, fierce CEO. You don't have a lot of companies like this because the guy is very blunt on earnings call. I just recorded a video about the things you don't see in a spreadsheet, like the tone of the management. RH is a beautiful example of this. Sometimes when you do an analysis of a company, the qualitative stuff, you don't see it on websites, Stock Unlock, FinChat. You see them when you listen to the calls. And Gary Friedman is a guy that can do massive buyback in 1 quarter. In summer 2024, for some reason, RH bought back 17% of the company. In 1 quarter, and the quarter after this, they completely stopped. and now they stopped. Like for 1 quarter, you buy back almost 20% of your company, and then you do nothing. Very risky behavior, but I like the flexibility and I respect the move. Okay, just so you know, it was a quick parenthesis on RH. It's a company worth a follow. Let me continue. Competitive advantage for this company, nothing big. Basically, they have great brands, good attractive pricing. They don't rely on discounts because their products are so good quality, and most clients are women, and women love going to Williams-Sonoma. So great stuff. You have the customer confidence. Macro shifts. Now let me continue. I want to show you some charts or the evolution of the company. Okay. Portfolio of 9 distinct brands. Maybe you know some of them. Pottery Barns, Williams-Sonoma Home, West Elm, Regeneration. These are the key brands, and you have some brands that are lower priced or higher priced, depending on your budget, depending if you have a small family or a large family. They have products for you. I went to their stores. It's great. It's clean. The products are of quality, and that's amazing. I went to their stores in Abu Dhabi, so obviously it was clean. Great experience. Digital first, not digital only. Yeah, this is one of the best e-commerce retailer. If you look at the next 10 years, for example, the world will go into more digital. The world will be online in 10 years, 15 years. Williams-Sonoma is poised to succeed in this environment. I mean, they have been preparing for COVID for so many years. If you look at the e-commerce revenues, most of the revenues are going through e-commerce. And this is the reason why they have such high margins. Let me continue. They will talk about AI. I mean, AI opportunity for a retailer. I'm not buying this at all. Customer service. I don't think they have an edge regarding AI. So let me skip it a little bit. 2025 priorities. Returning to growth. It will be hard. Elevating world-class customer service through AI and driving earnings. Yeah, I don't think they can return to growth. It will be much harder than anticipated. For the last earnings report, they guided for +2, -2 earnings growth. Like the guidance for next year is to grow at the maximum of 2%. Grow your revenue at 2% maximum. So between -2 and 2. Yeah, this is quite stable. So what's their definition of returning to growth? If you look at the revenue for the company, the CAGR, the compound annual growth rate, is only 5% for 20 years. It is not that high, actually. So just so you know, if you want to continue analysis Williams-Sonoma, don't buy it because of the potential revenue growth. For the past 20 years, the growth has not been extraordinary. But for the earnings per share, you have an earnings per share growth of 12% per year for 20 years. So the reason I bought Williams-Sonoma was all about efficiency. Now, how do they plan to grow their prices? In this industry of selling tables and beds, kitchens, etc., you can either price up or make an acquisition, or have more products, or be more aggressive with the marketing. Core brand growth, emerging brands. They plan to continue delivering great products. Nothing big. They have emerging brands, which is quite new. And they have a new brand, Rejuvenation. Sorry for the French accent. And they plan to double down on this one. Okay, very well. Let me continue a little bit. I want to go to the numbers because they just talk about their strategy now. The customer service, driving earnings. Oh, what's their plan? Driving earnings. We expect operating margins to be in the range of 17-18% in full year 2025 and in the mid to high teens in the long term. Okay, good. If you look at the operating margins of Williams-Sonoma, they have increased a lot during COVID, and when all other retailers returned to normal pre-COVID era for the margins, Williams-Sonoma didn't budge. Williams-Sonoma kept their high margins. If you look at the operating margins of the company. Look at this. I mean, you have this blip out of COVID, out of 2008. They had a 10% EBIT margin, 8% EBIT margin, and after COVID, they went up to 18% operational margin. And they don't plan to stop. And this is the reason why they are doing so good. So yeah, they can definitely do it in the future. Now, another point that impacted the stock price, the recent decline in the stock price, was also tariffs, because they will be impacted. They are great at cost discipline, so this will be a no issue. But what about tariffs? We have a 6-point plan for tariff mitigation, obtaining cost concessions, resourcing goods, further reductions out of China, passing on select price increases. Yeah, this is great when you have a brand that is quite pricey. You can continue to increase the prices and you will not have any churn from your customers. Supply chain efficiencies, reducing SG&A expenses. Yeah, I like it actually. And tariffs are short-term news, but they are already prepared and assessing the situation and telling us shareholders how it is. Like, okay, here is what we plan to do for tariffs. This is maybe the first time recently in 2025 that I see a slide for addressing tariffs with 6 key points. And yeah, pretty good. Financial outlook, what do we have? Zero growth in revenue, 3% growth. That's not good at all. But the earnings are growing at 17%. Return on investment, it's all about shareholders. The return on invested capital is quite high. Returns to shareholders, strategy will not change. So I see no change in capital allocation policy. Okay, now let me check the report, and that will be it. Let me check the financial reports on the year-over-year change. What is the growth rate? What kind of implementation they have? And capital allocation wise, what was their move? So we are fiscal year Q4 2024. So that all the numbers will be compared to Q4 2023. We are proud of our strong finish to 2024. In Q4, our comp came in above expectations at positive 3%. We exceeded profitability estimates with an operating margin of 21%. Wow, that's their highest operating margin ever. In an environment where all the competitors are decreasing their margins because they are struggling, efficiencies, supply chains, Sonoma is thriving with operating margins at all-time highs. Earnings per share of this success was fueled by the strength of our operating model. Yes, our standout seasonal offerings, our impactful collaborations, and a strong improvement in both retail and online furniture sales. Yes, on the full year, our comp ran down 2%. We delivered a record annual operating margin of 18% with a full year earnings per share of this. So for the full year of 2025, the operating margin is 18%. It's just the 21% EBIT margins were for Q4. Okay. Looking at 2025, we are confident in our strategies and competitive positioning. Despite an uncertain backdrop, we have been and will continue to be focused on returning to growth. Yeah, we will see. Enhancing our world-class customer service and driving earnings. We are innovators and operators and are well set up for a great 2025. I'm looking forward to seeing their guidance when it comes to returning to growth. Do we have guidance outlook? Okay. In fiscal year 2025, we expect net revenues in the range of, look at this, -2% to +2% due to the impact of the 1 week before. Okay, so in 2024, we had 53 weeks, and in 2025, we will have 52 weeks. Yeah, it doesn't matter, man. Your guidance is -2% to +2%. Okay, and the operating margins are expected to be the same. So I don't know why they are talking about returning to growth. Guys, this is a -2% to +2% revenue growth. So Maybe not. Maybe not. Over the long term, we continue to expect mid to high single-digit annual revenue growth with an operating margin in the mid to high teens. Okay, let me go directly to the numbers, right? Okay, what do we have? We have the comparison between Q4 2024 and Q4 2023. In terms of revenue growth, almost no revenue growth. In terms of SG&A, this has not changed. Oh, sorry, I have a bug. In terms of margins, net margins improve substantially. You get 1%, that is great. Okay, nothing big. Business as usual. What I like about Williams Sonoma, by the way, is they don't shock the world. They just operate with high efficiency. And this is great. This is great. If you look at the balance sheet for this company, what has changed? They have the same amount of cash. They have the same amount of receivables. Say they build up the inventory a little bit. No acquisition, no property, plant, equipment change, no right of use, no goodwill, no improvement over there. This is a very simple business model that is still operating business as usual. No debt. Look at this, by the way. On the liabilities part, you don't have debt. You have what is called lease liabilities, which are not mortgages, debt. Same thing for the long-term debt. You have long-term operating lease liabilities. So no debt for the company. What about the cash flows? That will be interesting. About the cash flows, the net income has improved a little bit. No major change in working capital. They have built up the inventory a little bit. If you build up the inventory a little bit, you reduce your free cash flow, by the way. Okay, let me check, let me think for a few seconds. What has changed on a year-over-year basis? They build up the inventory, so you have a gap of 300,000 regarding inventory. Look at this. Last year, it can be quite technical, so I will just take my time. Last year, this line was plus $200,000 in inventory. That generated an inflow of 200K. Okay? Or that's in millions or in thousands. So that's $200 million generated because they sold a lot of stuff. And that generated some good free cash flow. And now this year, it was not an inflow of money, but an outflow. So they built up inventory, and there is a difference of $300 million. Next, this is insignificant. Account payables decreased by roughly $100 million. So you have a $400 million gap. And this is a little bit. So maybe you can expect for the operating cash flows a gap of $400 million. Here you go. This and this. Between last year, you have less operating cash flows, $300 million less. So the conclusion from this part of the cash flow statement is the business model has not changed. The only difference is they build up a lot of inventories. That's it. That's the only thing you have to guess from this cash flow statement for the moment. Regarding the capex here, no big change in capex, increased a little bit. Regarding the buybacks, they doubled down on buybacks. In the past, they did $300 million worth of buybacks last year. Now they did $800 million of buybacks. Like they almost tripled the buyback program. They increased the dividend payment. Okay, very well. Very well. Okay, good. And if I go to Williams Sonoma here, do I see the buyback program evolution over time? Look at this. Boom. Quarterly. On a quarterly basis. Oh, okay. So for some quarters, in 2023, they completely stopped the buyback program. Look at this. You don't have any green bars for some quarters, for 2 quarters. 2 or 3 quarters in 2024 and in 2023, sorry. And then you wait a little bit, and in 2024 they resumed the buyback plans. Okay, fair enough. And I think they will continue to do buybacks in the future. So good report. Good report. I don't buy the return to growth. I think they will be fairly stable. What I think they can continue to do buybacks, and the only EPS improvement that we will see in the future, I don't buy their numbers of aggressive revenue growth. So the only improvement in earnings per share will come from more efficiency and buybacks. They talked about the fact, or they talked about their EBIT margin, right? They had an EBIT margin of 21%, and on the full year it was 18%. And the guidance for 2025 was the same operating margin. So they plan to be equally as efficient regarding EBIT margins. And they plan to continue buybacks. So on a pure EPS basis, maybe they can grow 5%. Yeah, I don't expect something huge here. Maybe they can stabilize a little bit, grow a little bit. So you have a business that can grow earnings per share 5% for 2025 and maybe improve more a little bit. And in a few seconds, we'll go to the DCF, and that will be the end of this video. Earnings per share, let me check the percentage growth. Percentage earnings per share on a yearly basis. Earnings per share decreased here, plus 10%, 70%. Oh, too bad. Too bad, I don't see it. Yeah, that's fine. That's your earnings per share evolution over time. So you see this is still a profitable business, and their main goal is to remain efficient. Remain efficient. So let's check the DCF. What kind of growth rate do we put? For the free cash flow or for the earnings? It will be very similar. You know what? Let me put earnings. It will be even simple. On Stock Unlock, they give you a growth rate of 25% by default because they take the 5-year average. But in the 5-year average, you include 5 years of the COVID era when everything doubled for this business. Efficiency doubled, revenue doubled, net earnings doubled. So maybe we will not take 25% growth rate. We will take maybe 5% growth rate. We can play around with some numbers. If you look at the earnings per share growth, that's fine. Oh, that's the net income. Net income can grow like 3%. They can do buybacks of 4% per year, and they can hike their dividend by 10% per year. And if these are your assumptions, what is the good PE ratio for this business? If you go to the free form, you look at the PE ratio evolution of Williams-Sonoma, what has been the average? The average has been 14 for this business. So maybe, yeah, around 14. Let's say this way. Let's say that they have a PE ratio of 14. If they have a PE, if you think that these are your assumptions, the business is overvalued, and the fair value is down 30%. You need to be down 30% to reach fair value. If you want this business to be trading at a PE ratio of 10, the business needs to be cut by half. I don't think it will happen again. This was quite an event. And if, so this is my base case for the company, and which is the reason I sold it, right? So I don't buy, I will not buy the company right now. I will wait for a further drop. Now, if you think, let's put the bull thesis for this company. If you think they come back to growth eventually, and the growth rate is not 3% but 5%, and if you think they can continue to increase the buyback program a little bit, maybe you think they deserve a PE ratio of 14. If these are your assumptions, the business is still overvalued. The fair value is 15% lower. Yeah, in all scenarios, I will not buy the company right now. Yeah, but if it drops, that's fine. If it drops, I would be very happy to be a shareholder again. The CEO is great. The vision of the company is great. The products are great. It's just a matter of valuation and price. So be careful, guys, with your valuation. Good earnings. Good. I like the report. Very simple. The business is doing well. The business is doing fine. It's just that the stock price is too high for me. but I encourage you to continue the due diligence at home, and I hope this was helpful to you. Maybe it was the start of your analysis for Williams Sonoma. So yeah, let's keep in touch with the earnings. Maybe I will update you with the future earnings for 2025. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.